Ladies and gentlemen, distinguished speakers, dear audience, it is my utmost pleasure to greet you all at the 2024 Financial Stability Conference, organized by the Magyar Nemzeti Bank, the Central Bank of Hungary, jointly with the Center for Latin American Monetary Studies and the Official Monetary and Financial Institutions Forum. My name is Katinka Szász, and I'm honored to be your host today and tomorrow at this event. Today, we welcome you to the second installment of our Financial Stability Conference series that we started in 2022, where 29 speakers from 4 continents discussed the short-term challenges and longer-term future of financial stability. These past 2 years have stressed the importance of financial stability, and the coming years can be expected to be similarly full of turmoil. The title of the conference reflects upon this. Turbulent times are indeed what we are here to discuss, to widen the knowledge of those involved in analysis and policy making. The very interesting and engaging presentations and discussions that we will hear throughout these 2 days will cover topics on the challenges of the current macroeconomic turbulences to financial stability, geopolitical realignments, technological advancements, and climate change-related financial risks. All of these topics particularly affect emerging markets. We are delighted to welcome you all, and we hope this conference can be a platform for reaching useful conclusions and finding common solutions for the challenges ahead. To channel in as many arguments as possible, we will provide the opportunity to the audience to ask questions and share their views after the end of most sessions. And now, I would like to invite Mr. Barnabás Virág, Deputy Governor of the Magyar Nemzeti Bank, to deliver his welcome speech.
Good morning, ladies and gentlemen. It's a pleasure to be here, and it's a pleasure to welcome you all here in Budapest. Welcome to the Magyar Nemzeti Bank, the Central Bank of Hungary. Besides all our distinguished guests, I'm especially happy to welcome Mr. Dominic Leberay from the Single Resolution Board, Mr. Manuel Ramos Francia from the Center for Latin American Monetary Studies, Christopher Garnett from the OMFIF, and Mr. Thorsten Beck from the Florence School of the Banking and Finance. 2024 is a special year as we are celebrating the centenary of the establishment of the Magyar Nemzeti Bank. This anniversary brings to our attention the importance of the historical perspectives when we assess current turbulent times and the re-emergence of the geopolitical risk. We are now in a decade of volatility, in a decade of great transitions, which analyze the crucial role of financial stability. We have faced a succession of overlapping supply and demand shocks after the COVID pandemic that have created a complex and uncertain macroeconomic environment. Nevertheless, the efforts of central banks and financial supervisory authorities since the 2008 Great Financial Crisis have proved to be fruitful, as the financial system has remained largely stable during the last period and even after the 4 years of constant economic shocks. The exceptional size of the stress that banks have managed to sail through is reflected, among others, in the increase in policy rates in the past 2 years. 450 basis points in the Eurozone, more than 1,000 basis points here in Hungary, as compared to the much lower stress scenarios earlier. Financial stability provided headroom to monetary policy to stabilize the economy and support the price stability. Banks' resilience can be summed up with a couple of headline figures for the EU banking sector. Return on equity is around 12%, non-performing loan ratios are below 2%, and strong capitalization is reflected in a capital adequacy ratio of around 16 to 17%. The Hungarian banking system has exhibited a similarly good performance. However, as we have an increasing amount of experience with macroprudential policy and crisis management that is being put to the test worldwide at this very moment as well, we might be able to identify areas to develop further. The return of the area of high inflation after a prolonged low inflation environment has posed a staggering challenge for monetary and macroprudential policy as well and highlighted their close interconnection. The necessarily rapid shift to a high interest rate environment has put pressure on the balance sheet of households and corporates, which could pose risk to the asset quality of banks. Individual weaknesses in business models coupled with increased volatility on the capital and certain commodity markets led to the failure of less resilient financial institutions and stressed the importance of sound liquidity and funding structures and rigorous regulation. We have once again witnessed the effectiveness of the latter during the past 2 years. We have lived through another major crisis in numerous countries right after the COVID pandemic without the emergence of a systemic-wide financial crisis. The history can provide useful lessons in relation to the current economic and financial stability trends. We need to look at the past, recognize patterns, and apply successful practices wherever possible. The energy security risk that we are still facing, but sustainability goals and green finances into the spotlight even more, especially in Europe. The financial sector needs to play a pivotal role in the transformation, not only because of its importance in financing the greening of the economy, but also due to the actual financial stability risk climate changes posed to the sector. The Magyar Nemzeti Bank wishes to be at the forefront of this process, and we hope this conference will also support this effort. Based on the experiences and challenges lying ahead, we can define 3 priorities for the central bankers and regulators for the rest of this decade. First, maintaining resilience in the financial sector and in the economy as a whole, including the state budgets in the form of reserves and safety buffers. Second, ensuring the openness to transitions and encourage the financial sector to support these megatrends, including digital solutions and green finances. And third, international cooperation at every level to tackle common issues together successfully and efficiently. This highlights the relevance and importance of this conference, the second installment of a series that Magyar Nemzeti Bank initiated in 2022, a physical occasion to meet colleagues involved in matters of financial stability, academics and central banks, and to discuss the most relevant issues of the field. Therefore, this is a special opportunity to enhance our international relations, share our knowledge, and widen our common understanding. We are happy that this event has attracted colleagues from a wide range of countries. We might come from the different locations and economic structures, but I believe we will all realize by the end of tomorrow that we face very similar issues in a lot of instances, especially in emerging economies. I wish you all a very good time here in Budapest. I'm certain this occasion will be a worthy continuation of the Financial Stability Conference series the MNB launched 2 years ago, and will support as building together a stable, resilient financial system that is up to the challenges to the future. Thank you very much for your kind attention.
you, Deputy Governor, for the inspiring remarks. And now it is my pleasure to ask Mr. Manuel Ramos Francia, Director General of the Center for Latin American Monetary Studies, to also welcome the participants. Mr. Ramos Francia, it is a pleasure to have you here.
Thank you very much. So, dear Deputy Barnabas Birak, esteemed colleagues from Central Bank's community, distinguished guests, it is certainly with great pleasure that I will also welcome you to this Financial Stability Conference, Turbulent Times, co-organized between the Magyar Nemzeti Bank, the Official Monetary and Financial Institutions Forum, and the Center for Latin American Monetary Studies, CEMLA. Now, I'd like to extend my sincere thanks to our co-organizers for setting up the agenda, and particularly to the Magyar Nemzeti Bank for hosting the conference. And so I wanted to thank Janos Sakash, head of the Magyar Nemzeti's Macroprudential Policy Department, and his team for the excellent work in organizing the conference. I also welcome the contribution of CEMLA's Financial Directorate to organizing this joint initiative. This conference marks a significant milestone in CEMLA's efforts to enhance cooperation and dialogue among central banks from diverse economic backgrounds, ranging from advanced to emerging and developing economies. As we convene today, our focus is directed towards topics that are instrumental in shaping financial stability and resilience in the face of evolving global dynamics. These include prominently the emergence of geopolitical risks, climate financial risks, and 3, the role of macroprudential policies in ensuring a resilient financial system, particularly in the current context of high interest rates and sustained inflation. Now, since its foundation 72 years ago, which makes us the oldest regional association of central banks worldwide, CEMLA's mission has been that of encouraging policies and technical advances that enhance price and financial stability as key conditions to achieve economic development. CEMLA has been fostering the cooperation between central banks, not only in our core region of the Americas, but also across continents, helping to disseminate international standards in central banks' policymaking and economic research in cooperation with our more than 50 member institutions. It is against this backdrop that the participation of the Magyar Nemzeti Bank in CEMLA as a collaborating member began in 2018. Certainly, the Hungarian Central Bank and our Latin American Central Bank members represent distinct regions with unique economic challenges and policy priorities. However, as it became clear when we jointly organized the seminar on new perspectives on central banking after the COVID crisis in 2022, the common challenges in areas including central bank digital currencies, climate-related risk, or managing risk derived from currency fluctuations mean that there is ample scope to learn from each other's experiences, as Deputy Governor Barnabas Birak was mentioning a moment ago. Now, by pooling resources and expertise across central banks in different continents, we at CEMLA seek to exploit strategic opportunities to leverage complementary strengths, to promote cross-regional understanding, and to advance in the shared objectives of price and financial stability. I'd also like to stress that the cooperation between the Hungarian Central Bank and CEMLA reflects the historical ties that bind Hungary and Latin America. While geographically distant, our regions share a rich history of cultural exchange and economic cooperation, fostered by the role of thousands of Hungarian immigrants across the Americas that since the 19th century have made important contributions to their adopted nations. Coming from Mexico, for instance, I must highlight the Hungarian origin of Frida Kahlo and the design of Mexico's Palace of Fine Arts by the Hungarian architect Géza Marotti. It is also noteworthy that the Magyar Nemzeti Bank is fast approaching its centenary, having been founded on June 24, 1924. This milestone coincides remarkably with the 100th anniversaries of several central banks within our region, including the Central Bank of Peru in 2022, the Central Bank of Colombia in 2023, and upcoming anniversaries for the central banks of Mexico and Chile in 2025. This coincidence highlights not only a shared historical experience, but also the enduring commitment and resilience of our central banking systems in navigating economic challenges over the past century. In that respect, I wanted to use this opportunity to highlight 2 key subjects that central bankers are discussing in the current macro context and that will be part of our discussions in the next 2 days. First, as central banks act to stamp out the current bout of inflation, questions have arisen about the impact that a world with higher interest rates than the previous one of more than a decade can have on financial stability. Along this line, allow me to highlight some key mechanisms linking higher interest rates to higher risk to financial stability and to underscore some policy trade-offs faced by central banks. We're all familiar with the fact that the global financial landscape has undergone significant transformations since the great financial crisis, which led to a prolonged period of unprecedented monetary policy accommodation and low interest rates. This response was crucial in easing access to credit, stimulating aggregate demand, and preventing the spread of financial stress in subsequent crises. The aftermath of the COVID-19 pandemic marked a shift in the paradigm, with disruptions in global supply chains and, in many cases, perceived excessive fiscal stimulus contributing to supply-demand imbalances, higher inflation rates, and the need for tighter monetary policy and overall rising of interest rates. Now, this abrupt change has signaled the end of an era characterized by low volatility, ever-rising markets, and subdued inflation, impacting both investors and policymakers globally. The unexpected persistence of high inflation levels has sparked intense debates among economists and policymakers regarding its drivers and implications. Traditional analytical tools like the Phillips curve have proven insufficient in explaining the current inflationary dynamics, highlighting the need for new perspectives and models to understand the complex interactions at play. The switch of regime in interest rates to higher ones can pose challenges to financial stability, as Deputy Governor Viraj was mentioning. When interest rates remain high for an extended period, borrowers face increased costs in servicing their debts. This burden is particularly acute for households and businesses with variable rate loans or floating rate debt instruments. Higher debt servicing costs can lead to defaults, reduce consumer spending, and decrease investment by businesses, potentially weakening overall economic activity. Now, but the implications do not stop here. Higher for longer rates can also contribute to increased volatility in asset prices, such as stocks, bonds, and real estate. As interest rates rise, the present value of future cash flows from these assets decreases, leading to downward pressure on their prices. A higher market volatility can have ripple effects across financial markets, impacting investor confidence, liquidity conditions, and the overall stability of the financial system. All in all, as all of you know, the global financial crisis was mostly about a systemic increase in credit risk, and reforms were designed to mitigate it, protecting depositors and ultimately taxpayers. That is why reforms to enhance the quantity and quality of capital were deemed to be crucial to make the financial system more resilient. Nowadays, for the purpose of financial stability, we're facing a world with increased interest rate risk, particularly after global indebtedness increased significantly in the decade previous to the outset of the COVID pandemic, as well as the very much increased duration of the debt incurred. As all of you know, as a result of the international effort to regulate banks more effectively, the latter have lost much heft in international financial markets, having gained enormous importance on leveraged players, like most non-bank financial intermediaries, particularly global asset managing companies. In this context, as we will see tomorrow, the nature of global asset managers, together with the rise of passive investing and of automated trading, including algorithmic and high frequency, led to a significant rise in liquidity risk when conditions in financial market become stressful. Further on, another source of financial instability resulting from higher interest rates has to do with perverse demand responses leading to complex financial dynamics. Usually when the price of an asset falls, that is, a certain interest rate increases, that asset will become attractive for some buyer in the market, and the market will balance. Nevertheless, under certain conditions, the fall in the price of an asset begets further price declines, giving rise to the possibility of a downward spiral in the price of the asset. Now, three recent examples of these perverse market dynamics are the case of the US Treasury markets, the very famous basis trade. Second, the pressure put on the insurance sector as a result of increasing long-term rates. And third, the nature of global asset managers as the main players in many emerging economies markets. Now, these arguments highlight the importance of considering the role of monetary policy in affecting financial stability risks. Looking ahead, central banks must carefully balance these objectives, employing a mix of monetary policy tools, macroprudential measures, and regulatory oversight to promote both price stability and a resilient financial system. Now, emerging challenges, the second topic that I'd like to comment about very briefly, are the urgent need to address climate-related financial risks. So a second aspect that I wanted to highlight relates to which is, in my view, the most urgent and complex challenge for central banks, to tackle the consequences of climate change and overall environmental degradation for financial stability. Now, I share the view that it should be the state that dictates climate and environmental policies. That said, the massive impact of climate and natural degradation crisis on societies and the economy implies that central banks do need to take these risks into account if they want to avoid failing to deliver on their mandates. In line with this, central banks globally are increasingly recognizing the urgency of addressing climate-related financial risks, given their potential to disrupt economies and financial systems. At CEMLA, we have been contributing to these efforts through the Climate Financial Risk Center, a capacity building and research initiative built on the joint endeavor between the Finance Initiative of the UN Environmental Programme and CEMLA. At this stage, it should be clear that all of us, that climate risks, including physical events like floods and transitions risks from changing regulations and consumer preferences, threaten economic and financial stability. But the sources of risks extend beyond climate change itself, including aspects such as environmental degradation through biodiversity losses and natural capital losses that impact financial systems through complex interactions. Tomorrow we will share the results of recent research, how natural capital losses can, for instance, trigger a geographical reallocation of banks' activities, creating a natural capital depletion spiral with critical consequences for the environment. Central banks and supervisors are urged to expand their traditional mandates to consider the impact of climate-related risks for both price and financial stability. Against this backdrop, a green macroprudential framework can have a complementary role in curtailing climate-induced systemic risks. However, integrating climate risk into a financial stability policy framework requires that central banks have the capacity to accurately identify, measure, and monitor these risks that pose the largest threat to the stability of the financial sector. It is in this area where I see the most immediate challenge for central banks. At CEMLA, we are working together with central banks through collaborative research and model development, for instance, in the areas of ESG modeling and climate stress testing. Such efforts align with global initiatives to integrate climate considerations into financial stability policies. So let me stop here by welcoming you again and thanking our hosts for the organization. I wish you very fruitful discussions during the conference, and thank you very much for your attention.
Mr. Ramos Francia, thank you for the kind words of welcome. Now I would like to invite Mr. Christopher Garnett, Senior Advisor at the Official Monetary and Financial Institutions Forum, to deliver us his welcome speech as well.
Good morning, ladies and gentlemen. It's a great pleasure and an honour to be here representing OMFIF today, the Official Monetary and Financial Institutions Forum. Now, I'm not going to offer any startling new economic or monetary insights, and there's going to be an enormous amount of technical discussion following over the next couple of days, so I thought I'd restrict myself to a few brief personal observations and also tell you just a little bit about OMFIF. Congratulations to the Magyar Nemzeti Bank on your centenary, and thank you very much, Barnabas, for the invitation here. So a quick look at the agenda for this conference, and even just listening to what Barnabas and Manuel have already told us, it's pretty clear that modern central banking is not a question of moving the interest rate dials occasionally while sitting on top of a big pile of gold bullion. I'm going to mention gold again in a moment. Just for a moment on OMFIF, for any of you who aren't familiar with what we do, it was founded about 15 years ago in London, and it began, and at its core remains, a membership think tank for central banks. So the discussions here today and tomorrow are at the heart of what OMFIF has already done. And Magyar Nemzeti Bank is a long-term member alongside the 100 or so central banks from around the world that regularly take part in OMFIF-led research and discussions on topics from central bank digital currencies. We've got a separate thing called the Digital Monetary Institute that's been a great success, to how monetary policy can help drive the global energy transition. But nor does OMFIF ignore the older version of central banking either. As OMFIF's chairman and founder, David Marsh, whom many of you will know, I expect, as David reminded me, the MNB got an interesting mention in a piece we published a couple of months ago about central banks' gold reserves. The Hungarian central bank having multiplied its gold reserves by more than 30 times in a couple of years. And as you know, the price of gold, even as we speak, is testing new all-time highs day by day. So perhaps there's something in those prices to be said about stability and indeed turbulence. And David Marsh is obviously sorry not to be here in person, and I bring his warmest greetings to all of you. So the inner workings of central banks in monetary policy and other areas are OMFIF's specialist subject, as I've said, and the reserves management function of central banks forms the subject matter of one of our longest-running annual research pieces, where we survey reserves managers on their asset allocation strategies for the year ahead. That's published every year, and 70-odd central banks filled in the survey for the current one. But in the last couple of years, we've broadened our range of activities by establishing a sovereign, supranational, and agency debt institute that's brought the other side of the public capital equation into focus. So sovereign bond issuers, not least Hungary's, and the gigantic non-sovereigns like KfW and the EIB and the World Bank and so on, they need the owners of public assets, public pension funds, as well as central banks and other monetary authorities, to understand their funding needs as borrowers, to understand their credit stories, their ESG borrowing strategies, their green, social, sustainable issuance taxonomies, and so on. And our SSA Debt Institute channels that dialogue. Last year, we ran an extensive program of analytical and investor relations work in close collaboration with the MNB, also with the Hungarian Ministry of Finance. And I'm going to give this a go with the Államadósság Kezelő Központ, that is the AKK, Hungary's Public Debt Management Office, and the principal face of Hungary in the international capital markets. Now, anybody who follows this country in the international press, even in the specialist international financial press, will find that reporters love to focus on political squabbles with the European Union. The successful economic story and the technocratic management of the economy by entities like the MNB, like our host today, and like the AKK, these tend to get ignored. So our program was designed to refocus attention a little on that. We had an investor conference just over the river in Pest. We had the honor of Budapest giving an opening speech there as well, along with His Excellency Mihály Varga, the finance minister, and portfolio investors from some of the world's leading asset management firms came from London, Munich, Vienna, Paris, to bring themselves up to date with the coherent story of monetary policy, successful fight against inflation, and the record growth in FDI in Hungary. These are, of course, the financial and economic bullocks of this wonderful country in times of immense stress and conflict. And if you'll permit me to offer a moment of personal explanation of that wonderful country remark I just made, it isn't just the throwaway comment of a flattering, quick visitor who wants to please his host. I first came to Budapest in 1987, and these were the days of goulash capitalism, when suddenly, overnight it seemed, you had about a score of new banks created. Few of them had proper premises, but they all had a general manager, a CEO, a managing director. And I had the honor of meeting most of those people, acting then on behalf of Euromoney, as their host at the Ballantyne's Business Club on the other side of the river, which was then very much a focal point of business life in this rapidly changing capital. It was my first step behind the Iron Curtain, my first visit to an emerging market, and it made a profound impression on me, and I've been privileged to enjoy dozens of visits ever since. And when I was asked to come to this conference, it seemed to me a bit of a coincidence that the other partner, the Centro de Estudios Monetarios Latinoamericanos, embodies another topic I found always fascinating. In more than 30 years of visiting all the countries of Latin America, I've seen huge economic and societal changes there too, of course, and often bravely standing for continuity, stability, and orthodoxy against a background of political shenanigans of every kind. It's been the region's central banks, the central bankers of Latin America, that have been the stars on the region's economic and business stage. And there have been some remarkable personalities too. One thinks of brilliant Brazilian central bankers like Gustavo Franco, Arminio Fraga, giants of Mexico like Guillermo Ortiz that Manuel and I were just reminiscing over, of the flamboyant, charming, yet steely Martin Redrado, who literally barricaded the doors of the Banco Central de la República Argentina against the incursions of Kirchneristas, literally, physically. And in Peru, Julio Velarde has been head of the Banco Central de Reservas for nearly 18 years, and amidst all the political chaos that's beset one of the countries closest and dearest to me, Don Julio has been the beacon of stability and robust economic growth, very much in spite of unremitting congressional and presidential turbulence. Have we got any Peruanos here from the Latin American delegation? Sadly not. Well, I'll be the representative of Peru. Dr. Ramos mentioned the Hungarian diaspora in Latin America, and that's one of the first things I learned about Latin America, is that you can be a Latin American and be from anywhere. You have a mixture of a Chinese name with a Polish name, and indeed when I first went to Paraguay, President Wasmosy, of course, his family was from Debrecen. So, ladies and gentlemen, these are just a few personal reflections on Hungary and Latin America before we get down to the serious, crunchy, meaty and technical discussions of the day. Once again, I'd like to thank Deputy Governor Barnabas Virag and his excellent team for organizing this conference and bringing all of you together. And it's an honor for OMFIF to be playing a small role in these proceedings. Thank you very much indeed.
Thank you, Mr. Garnett, for this kind welcome. Next on our agenda is the keynote speech of the conference. I'm delighted to invite to the stage Mr. Thorsten Beck, Professor of Financial Stability and Director of the Florence School of Banking and Finance. Mr. Beck, the stage is yours.
Wonderful. Well, good morning. First of all, I'd like to express my gratitude for the incredible hospitality of Magyar Nemzeti Bank and for bringing us together here in this beautiful building, although I understand it's not the actual historic building that will only be available for the next round, I think, of the Financial Stability Conference. I'd also like to thank, of course, the two co-organizers, CEMLA and OMFIF, Dr. Ramos Francia, Mr. Garnett, for inviting me and for allowing me to make some remarks at this event. So what I'd like to do is give a very broad overview of financial stability and, as I see them, some challenges that are ahead of us. I'm not going to get too technical, I promise. It's more of a kind of a general overview, maybe also kind of drawing a little bit lessons from what we've seen in terms of macroprudential policy in both over the last 10, 15 years, where again, actually this region has been at the forefront of, in Europe at least, in terms of experience with macroprudential policies, but also the pandemic, of course, and then also the just recent events in 2023. So, but being a good academic, I'd also like to start kind of with the basics. So here I'm going to start with a little definitions of what actually financial stability means. I mean, financial, if you put it the other way, financial instability, fragility, that's kind of, we know when it happens, because then when we see turmoil in the markets, we see central bankers, supervisors getting very nervous. But what does it actually mean to have stability? A condition, as defined here by the ECB, and there are similar definitions by other institutions, in which it's conditions in which a financial system, in the broadest sense, is capable of withstanding shocks, resilience, and the unraveling of financial imbalances. And it is easy sometimes when we are here among us, so to say, among technocrats, to focus just on that objective, just saying, oh, financial stability, that is our target function, that's what we want. We want to avoid instability, we want to foster stability. But of course, it's always important to remember that financial stability and also the task of authorities, regulatory supervisory authorities, has to be seen in the broader sense of the societies and economies that we serve. So why do we care about financial stability? Because we see, when it breaks down, we see the negative consequences, the disruption of credit flows, of payment services, loss of access to savings, to deposits, and when it comes to a crisis, we've seen it also again in Europe, in Latin America, in other emerging markets, very high costs. Fiscal costs, but ultimately output costs. And it's not, typically has been shown, not a cost that is just a one-time cost which then can be recovered. No, there's a permanent output loss. We go back to a growth path. In the best of cases, we go back to the previous growth path, but at a lower level of output. Financial stability, what is the difference between financial stability and bank failure? Well, we know, as the Irish say, or is it the English? It never rains, it always pours. Both on a global level, banking crisis comes rarely by itself. There are global financial crises. But also in terms of, in the right-hand side, if you look just at a specific country, a bank rarely fails by itself. You have these, over the last almost 100 years now, these waves. Of course, the end of the Great Depression, the S&L crisis, the global financial crisis. And if you kind of continue the graph, you would see another peak in 2023. Now, if you look at today, and I only looked at the VIX, so maybe what Mr. Garnett pointed to, the gold price, maybe tells us a little bit a different story. But it seems that the risks have kind of receded. We've seen these big peaks, spikes in 2008-9, then we did the second decade of the century, the Euro debt crisis. We've seen it, of course, in spring 2020, the dash for cash. But things seem to have calmed down, and one wonders, and I'm afraid my picture is not as nice as this one here, but is it really just a calm before the next storm, or are things really calmer? Have they really calmed down? I mean, I would argue that it might be the calm before the next storm. So I'm on the more skeptical side, I have to admit. And some of these themes have actually been already touched upon in the opening remarks. So we are living, I would argue, in times of great volatility. We've seen quick monetary tightening. We've seen actually transmission into interest rates, both lending and deposits, at least in the euro area. It hasn't really been complete. It's actually been also much slower than in previous cycles. But now the focus is on when can we go down again? And will the expectation be matched to actual actions by central banks? We've seen, of course, now in Latin America, for example, interest rates have actually already been reduced. But, of course, any movement in monetary policy will be also subject to any unexpected shocks that might come up there. We've seen bank profits going up, in some cases, quite spectacularly, with the interest rates, but I mean, the non-performing asset ratio is still at a low level, but it seems there is some movement. The movement is upwards, not downwards, let's put it this way. And of course, there is the commercial real estate issue. And as a parenthesis, for example, I do believe that bank windfall taxes, as for example, designed in the country where I live currently, in Italy, is not really the right tool, because these are actually not windfall taxes, I would argue. These are cyclical, windfall profits. These are cyclical profits. And I also think it's the wrong tool. I think tightening capital requirements, asking banks to be careful with dividend distributions, I think is a much better tool in order to build up buffers during these temporary good times for banks. Now, we've also seen, again, a theme I come back to, that there's much higher depositor mobility on a more general term, in the sense that people changing banks, also more competition, less also loyalty, if you want to say so, to your home bank, but also, especially during crisis times, much faster depositor runs. I mean, during the global financial crisis, it took a couple of days, if not weeks, to kind of get banks getting in serious trouble. Now, with Silicon Valley Bank, I think it was 2 days. With, of course, related to also social media and the instant payments that we have available now, which, yes, might require higher liquidity buffers, and we have, of course, introduced liquidity buffers after the global financial crisis, but also alternative kind of tools to manage these kind of crises. There is the threat of cyber risks, which we cannot really address, I would argue, with capital buffers, because these are risks which I think in Latin America you used to refer to as peso risk, which is kind of a tail risk, very small probability, but the effect will be enormous. And there is no capital buffer that can actually buffer this against this risk. So alternative tools, including macroprudential tools, such as backup plans, crisis management plans, but also more cooperation. Both private and public sector, I think, are urgently called for. There's also the issue, of course, more broader issue, that we rely more and more on third-party providers for IT services. And often this is a very concentrated market. So actually, when we sometimes talk about the link between big tech, technical tech firms, going into finance, well, they're actually already there through, for example, cloud services. Well, you do have geopolitical risks, that's very clear. Currently in Europe, but there are tensions in Asia. And then, of course, later this year, elections. And I think here it is very clear, as I mentioned again earlier, that we are living in very volatile times. We are living in a situation where democracy, freedom, peace in Europe, but also globally, is under threat. In Europe, from enemies within and outside, from populist, autocratic parties that often work with slogans, populist slogans or anti-European slogans, but also from enemies outside. Aggression, violent aggression from the East, but also populist indifference, ignorance from the other side of the Atlantic, which might possibly turn into a trade war next year. So as you can see, there are lots of risks, lots of possible shocks that are on the horizon that could come up, known unknowns, but then there are also lots of unknown unknowns, again, additional risk factors that we don't know anything about. Again, I just remind us, December 2019, when the first news came in from some kind of virus in China, which then we know the rest. That was certainly an unknown. So I think we are living in times of great volatility, and I think kind of lowering the guards and saying, well, yes, things have calmed down. Yes, they have calmed down for the short term, but I think there is the potential for quite a lot of volatility. And again, it's important to keep in mind we are focusing on financial stability, but we are part of a larger society economy that faces enormous risk and enormous challenges right now. What are the roles of macroprudential authorities in turbulent times? Well, so again, being an academic, and some of you in this room might disagree with maybe the focus or focus on some of these bullet points more than others. There are different objectives being defined, and again, different authority might have different objectives. In the broadest, the more broader dimension is prevent the excessive buildup of risks that can result from external factors, smoothen the financial cycle, or, if this is too much, at a minimum, make the financial system resilient to the financial cycle. So there's a narrow definition, resilience, and a broader to actually help smoothen the financial cycle, which again, it might not always be feasible, especially in times of supply shocks. That's also sometimes what we refer to as the time dimension of macroprudential policy, and it also has been often the focus when we discuss macroprudential policy. But of course, there's a second one, which is make the financial system resilient to the failure of systemically important institutions and limit contagion effects, so the transactional effect. Here, we often focus on financial institutions, but again, the point I just made previously is that there might also be non-financial institutions, cloud providers, or 2008 insurance companies that have a critical role. And then finally, there is the more structural view, a system-wide perspective to create the right set of incentives, and also to be on the lookout for new sources of risk, of fragility. And actually, that's almost my favorite definition of financial stability for macroprudential policy, is to see where might the next crisis come from. Because we know lots of these policies, these regulations have been put in place as a response to the previous crisis. But we know the next crisis might come from somewhere else. So being in the lookout, for example, in the area of non-bank financial institutions, for new sources of fragility that might affect the banking system, the financial system, economy at large, I think is a very critical function of financial stability departments and macroprudential policy authorities. So if you think about this, how have these policies performed? And again, a lot of this evidence comes not from the region where I have been based for the last 16 years, but more from this region, Central Eastern Europe, but also Latin America, because that's where there's much more experience with macroprudential policy. And yes, it can be successful if it is binding. It seems it is more effective in the upturn, meaning in the credit cycle going up, so putting certain breaks in there to prevent overheating, than in a downturn. I'm going to come back to this when I talk about the pandemic. There is a continuous challenge of leakages, meaning regulations, macroprudential policies are focused on, obviously, regulated institutions. And we know financial sector participants are incredibly smart people. They know how to get around these things. There is always the option of alternative providers, be they foreign branches not subject to macroprudential, be it non-banks, be it fintech. There are examples from across the world where there are leakage effects, and it's more a question how much they are than whether they are or not. It seems that for cyclical effects, borrower-based measures seem to work somewhat better. In resilience purposes, it seems that lender-based measures, talking about capital buffers, for example, or what in Spain was the dynamic provision, work somewhat better. Importantly, something to take into and keep in mind is that there are differential effects. Of course, we know that smaller enterprises, higher, lower income households are more constraints, and they're typically also more affected by these macroprudential policies. Similarly, banks, of course, according to their capital strength, some of these macroprudential tools might become binding or might not become binding. So again, it's important to take into account these differential effects, which in turn, in the case of households, in the case of firms, might also have distributional effects, which of course gets us back to the politics part. One important thing, actually I'm going to come back to this at the very, very end of my conversation, is that there is a part of the academic literature that tries to define the optimal macroprudential policy. We also know that this, in reality, is not always possible, because we want to have robust, and sometimes we need crude measures which might not match one-to-one, map one-to-one with optimal one, but might be more effective and might be more easily implementable. Now, if we go back to very specific now to the pandemic period, the macroprudential tools during the pandemic periods, where I was also a little bit involved, what we've seen, of course, across Europe, across the world, a very aggressive release of capital buffers, different ones, counter-cyclical, where they had been actually built up, for example, not in the euro area, conservation buffers, Pillar 2 buffers, with the objective to support lending to the real economy, support other measures by fiscal policy measures, for example, guarantee schemes by governments, also the monetary policy easing of the spring 2020. I would still argue they're successful. Of course, success is always a relative word, and as a relative assessment always depends on the counterfactual. There has been the argument that banks have not used these capital buffers as much as they could have, which again might be also understandable because there is, of course, a signaling to investors in here. They knew there was a future reversal, so they would have to build up capital again. And of course, one of the reasons why we kind of went for macroprudential tools, so ease it for everybody, was, of course, to make everybody kind of good at the same time. But of course, we know when they are being taken away, then some will look better than others. And the one that don't look as well, they might then actually be punished by the market afterwards. So this kind of signaling effect might have countered some of the intended effect of the easing of the capital buffers. There was a second important policy, which actually was, I would argue, goes hand in hand with that, and there was the restrictions of profit distributions, which at least in the euro area and in Europe was actually stronger than in other parts of the world, which was basically to avoid risk shifting. Banks, of course, financial institutions more generally, they benefited a lot from support policy, monetary policy, fiscal policy, regulatory policies, and to avoid the risk shifting into equity holders, restricting profit redistribution was an important tool. And I think actually the assessment, and they have been now written, I think, like a dozen papers of that. Looking back at this, I think in general the evidence has pointed to positive effects in the sense that the debt prices went up, equity prices went down. If there had been risk shifting, it would have been the opposite. So it's I think, successful. Although I want to also say that in the context, and that's more a Europe-specific discussion, it showed again the limitation of the European Banking Union, maybe broader European Financial Union, in the sense that the ideal option would have been to, of course, impose these restrictions on the single market level. It wasn't the case. Some countries did actually impose them also on subsidiaries of other European banks with very good arguments, because the fiscal policy came on the national level. It was the national governments that supported banks indirectly, including subsidiaries of Western European banks, for example, or other European banks. So again, it's not something to be criticized, I would argue. It's something just to say that, again, it shows the limitation of working in a single market that is not quite complete. It doesn't have all of the risk-sharing elements in place quite yet. There was a discussion afterwards to make some of these tools, for example, dividend restriction, part of a permanent toolbox. I actually argued against it. I don't think it's a good thing because there are certain tools that are for once in a century situations and should not be used on a regular level, because we have to understand dividend restrictions are an intrusion into property rights. And yes, there is a case to be made to undertake them, but only if it's really a kind of means of last resort. Now, if you go forward 3 years, actually almost exactly 3 years, we have the 2023 turmoil, which I think, again, provides us some lessons, some general lessons. Number one is, and that's an old-standing kind of result from also the academic literature, is that if an institution, if a bank grows very quickly, that's typically not a good sign. That's a sign for trouble ahead. And I think that's what we had in the case of SVB. Maybe not surprising, because tech companies made a lot of money. Tech companies were the clientele of SVB and CEMLA banks, and they, of course, got lots of deposits. They had to use this deposit. There was quick growth. But, of course, that, again, put the seed for the coming trouble ahead. I think a second lesson is that there has been actually quite an influential paper a couple of years ago that argued that yes, banks are subject to interest rate risk because that's part of their business model actually, to transform maturity, to transform liquidity, and that implies interest rate risk, but that there is kind of a natural interest rate hedge coming from the deposit franchise on the liability sides into the adjustment of interest rates on the asset side. And that holds on the cross-section, it holds, as was shown in this paper also over time. But of course, this interest rate hedge kind of breaks down in the worst moment, like in 2023. But it also shows that the fragility, which is again part of the business of a bank, can actually make this interest rate hedge very fragile and kind of go away basically overnight. And which also then, of course, we learned that it really depends on not just the depositors per se, insured versus uninsured, but also the concentration of depositors. And is there a linkage between these depositors, such as in the case of SBB, where there was a common venture capitalist funder behind many of these clients. Now, we also learned again, and that's again not a new result, that most deposit runs are a combination of solvency concerns, such as in the case of SVB, and coordination failure, which the economist is an economics expression, which basically means that you don't want to be the last depositors arguing at the cash machine. So it's panic, but at the core is a fundamental issue about solvency. And again, as I argued before, these runs have become much, much quicker because also of social media, because of instant payments. What does it imply for policy design? So one thing is, and I think it's actually already the case, but it just reinforces this again, that interest rate risk in the banking book and the treatment of it should really be a function of the fragility of banks' funding. And without going into the whole debate about mark-to-market versus book value of assets, which has been in discussion for the last 50 years or longer, I think rather than having this discussion, it is really how to treat this, the assets and the risk coming from assets that might be volatile as a function of the funding fragility of banks. And I think, again, that's to have this in Pillar 2, I think is a very useful, rather than, it's a useful tool rather than having it in Pillar 2 and have one size fits all, which, again, shouldn't work as we've seen it again during the recent crisis. Now, we've also seen that after the failure of Credit Suisse, sorry, it wasn't a failure, it was a merger with UBS. Too big to fail is alive and kicking, and it won't go away anytime soon. I think thoughts after the global financial crisis, after the establishment of the of SSM and so on the BRRD, SRM, illusions that we would get rid of this, that we might actually make these banks really resolvable and have no bailout, I think were naive. I think it's more a question now how to deal with these too big to fail banks rather than, I think, pretending that we can actually resolve them and maybe even shut them down. I think that's... and then finally, again, something that came out of especially the US crisis, in terms of deposit insurance, there's always this question on de facto and de jure. De jure, there is a limited deposit insurance. De facto, in many, but not all cases, at least in the US, I think in all cases, there is the de facto deposit insurance of 100%. It seems in the bank runs, there is still uninsured depositors, even if they might think they will be ultimately made whole, they are still running, sometimes even insured depositors because they don't know when they will get access to their funds. But there is clearly this trade-off between market discipline, not having banks to have like a risk-insensitive source of funding there, which again might make them take too much risk on the one hand, but also having deposit insurance to ensure instill confidence and stability in crisis. This trade-off is still there and to be carefully managed. What is the role of supervisors? So here in Europe, not sure whether anybody from the other side of the Atlantic is here, but we are quite proud in Europe that that this hasn't come over to us, right? So there was SVB and Silvergate and First Republic, Credit Suisse, problem state in the mountains, in the Alps. And I think there is something to be said about the success of European supervisors, including about the SSM. There is something to be said about supervision within the euro area, going up to the supranational level and kind of taking it away from national levels, which in many euro area countries was too close to the political sphere. And I think this has really strengthened bank supervision in Europe. I think also the emphasis of the SSM on business models, again, think SVB, concentrated depositor funding, in strong investment in government bonds. I think this focus on business models at the SSM is a very, very useful one, as well as the governance structures. Boards oversight, for example. So I think we've learned that, yes, business models in banking matter, governance structures do matter. As I mentioned earlier, I think having interest rate risk in the Pillar 2 is very useful. There is, of course, also a trade-off, as we know, between capital and liquidity buffers. Liquidity buffers can reduce also profitability, solvency. So the question is to address which risk with what, or to have a combination of tools. And of course, there is the whole issue of rules versus discretion by supervisors, where this discretion, that's my next point, should actually be related even more to stress tests, including also liquidity and interest rate stress tests. Again, we've seen the problem SVB arising from the rapidly increasing monetary tightening. And then finally, now again, I would say in Europe we've made lots of progress in supervision. I would argue we've made much less progress on resolution. I know we're going to talk about this later when Dominique has arrived. But I think we haven't really put into a place in Europe and also in the euro area a robust resolution regime. I mean, we've had, I think, a total of 3 resolution cases. We had, I think, very few, if any, liquidations. What we do have is preventive. We have preventive recapitalization, which is the new word for bailouts by government. So I think there is much more to be done, and I'm going to come back to this in actually just a moment. There's also the issue that focusing more on recovery, so before a bank actually going into possible resolution and being fail or likely to fail, is actually becoming more important. Now the CMDI approach, the CMDI proposal, which again we will probably discuss later, is an important step in the right direction. More coordination between competent supervisory authority, resolution authority, broadening of the public interest rate criterion, which currently is really only for 100 or so banks, which can easily circumvent it, and then going into forcing governments basically to do preventive recapitalization, such as in the case of some Italian banks. I think also a stronger role for deposit insurance schemes, deposit guarantee schemes in the resolution process. In some of the European countries, we've had traditionally a very strong role, like in Germany, for example. So really involving them, enabling the involvement is an important one. There is the politically sensitive issue of removing the priority of insured and therefore of deposit guarantee scheme when they step in, deposits compared to uninsured deposits. As I understand, this is actually a politically sensitive point, which kind of is one of these issues that keeps the CMDI from being approved. Of course, we also have the issue with the zombie banks. I think there was a Latvian bank, if I remember correctly, that had this bank license has been declared fail or likely to fail, but has this banking license not being withdrawn. I mean, this is really a small step, I would say, in the right direction. But as you can see, even now, it is incredibly difficult to actually go it through. Which then, I mean, with some other economists, including Nicolas Véran, we just, I think last year or the year before, we wrote a piece where we said, well, can we go from a limited to a real deal, where we would need much more, much stronger resolution, and maybe also go away from this idea of liquidation for the majority of banks, and maybe also recognizing that the push for bail-in has simply gone too far. We just need more flexibility more tools for the resolution authority, and also put it up more on the euro area level. I mean, resolution, bank failure management is a politically sensitive topic as supervision. We managed to put supervision on the euro area level. Maybe it's time to also do it for the resolution. Of course, we also know that the banking union, the SSM, has not really resolved the bank sovereign fragility, the potential link between bank and sovereign fragility. There is no indication that any of this is right now, but there is still the risk there. There is still this concentration issue of banks in the euro area on sovereign debt of the same country, of the home country. And that system can pop up. The ECB stands ready to intervene, but is that really enough to kind of, is it also politically sufficient to address this issue? So, looking forward, just a couple of more points I'd like to make. We have, of course, I've talked a lot about banks. I guess a bit like the drunken driver who was looking for the car key below the lamppost because that's where the light is, not where the key. He lost the key. But there is, of course, an increasing focus on the non-banking sector, which I think is important, but also on, even more important, on the linkages between the banks and the non-banks. I mean, there is a very interesting paper by Viral Ashaya looking specifically in the US, but we also know in Europe, for example, that most of the funds that were mentioned earlier are actually owned by the banks. So there is a close linkage between banks and non-banks. So it's not that non-banks are kind of a substitute for banks, but it's just a tool for risks that are kind of outside the regulated banking sector. We have the whole liquidity issue that I mentioned earlier. And of course, we're looking forward, again, as mentioned, I think by all three introductory speakers, the climate risk as a new risk coming up, as a different kind of risk, because it's not a risk that might come, but it will come. It's sometimes not referred to as the black swan that comes every 50, 100 years, but it's the green swan. We know it will come. We might not know the exact form it will come, where it will hit, how it will hit, depending on the different climate scenarios, but also, of course, different reforms, different policies being put into place by policymakers in terms of the mitigation of climate risk in the transition to net zero. So the issue is really, and there's also a little bit of another contradiction, a tension. On the one hand, is this to be treated as a pure financial stability risk, which calls for higher capital buffer, for example, the use of the systemic risk buffer? On the other hand, we also would like to have more funding for green transition. Is it a role purely of the banking sector? Should it be outside the banking sector? How do we think about this? And is there like a trade-off attention for regulators when focusing on these tools, which might not always overlap? As I mentioned earlier, with digitalization, there is, of course, the issue of new entrants, fintech, possibly big tech. I'm a little bit more skeptical about this now. But again, the platform firms have already arrived through offering these cloud services, for example, the use of platforms. And that is, of course, can turn into stability risks. And that is not really being addressed as I see it now, at least not directly at this provider level. It's more, again, in this case, it's the client level, which are the banks. Right. Now, let me very briefly, so I've talked about stability so far, but I think there is, again, we are not talking about stability just as a purpose per se, but we're also talking about it because ultimately we want the financial system to serve the real economy, to serve society. So if we want to have an efficient, thriving financial system, of course, it being stable, being sustainable is, of course, a precondition. But we have to look beyond this precondition, and of course, that is a discussion that has, again, started in the last couple of months here in Europe about strengthening the non-bank part of the financial system. And yes, we do need it. We need it for the transition, or for the double transition, digital society, transition to net zero. We also know that from research that banks might not be in the best position to actually fund the green transition because they are too worried about their legacy assets. So they might not fund these innovative firms in green industries or in dirty industries, innovative firms in dirty industries that actually want to transform industries and economies. So we do need a stronger reliance on what is kind of generally referred to as capital market union, but of course it's much more. It's non-bank in the broadest sense, institutional investors, public capital markets, private capital markets. Again, some of these segments also posing risks, but again, also posing opportunities. What has to be done? I mean, and again, there's a very important difference between banking union and capital market union. Banking union, we kind of know what had to be done, and we know what has to be still done. In capital market union, it's a much, much broader area. However, we also know that there are scale and network economies in capital markets, even more in non-bank sector, even more than in the banking sector. And I think, again, as in the banking union, national politics kind of stands against this kind of European solution, which doesn't mean we need one big stock market somewhere in Europe. I'm not going to name any cities now. But the fact that, for example, after Brexit, all kind of different countries and different cities try to compete for a piece of the London financial centre, which they were more or less successful. Again, very understandable, but it kind of goes against the idea of the capital market union, actually. So I think it's a very broad initiative. I think, yes, it is a lot of different initiatives. There are some very difficult parts to it. Think about insolvency system. I think converging legal system is, I think, it's close to impossible. But I think what we need is really need a champion that drives this agenda. And I'm not sure whether like the Commission can be it, or maybe somebody like ESMA should actually be it. We know that in Europe, reforms often happen in crisis situation. The climate risk, yes, it is also a crisis, but it's a kind of slow-burning crisis. Well, yes, fortunately, it's a slow-burning crisis, but also unfortunately because it does mean that things are not really happening as quickly as they want. So I think, I mean, this is more like almost like a political economy question, which is, I guess, beyond my pay grade as an economist. But I think there is a discussion to be had. How do we actually get there? Do we need a big quid pro quo, as we also had in the case of the banking union? Do we need a champion, for example? What kind of political constellation do we need to actually drive this project forward, which I think, again, is very critical. Stability, but more importantly also for the financial sector being a driver of these double transitions. So, in summary, and maybe I'm trying to end on a little bit of a more positive note, we are living in positive and volatile times, very volatile times, I would say. There is more shocks to come, which we might not even be aware of. I think we are better prepared than in 2007-8, because I still remember the first decade of the century that things were just too big, too nice. They were just more low interest rates, high growth, and everything looked perfect. So I think we are much, much better prepared. The question is, and I forgot the question mark here, are we prepared for the right shocks? That's the big question. In Europe, I would argue we have kind of lost a bit the reform momentum, but we cannot really afford to wait for the next crisis. Lots of long-term challenges, especially related to climate change. And I think we need another push for the capital market union. It's also a challenge for the regulator, because beyond coming up with regulation and because beyond implementing them, it requires a very agile and very flexible approach with new shocks coming up, with new risks popping up. I think we've seen a lot of good reactions over the last couple of years, but I think it's an ongoing challenge. Let me, and I'm looking at the clock in the back there, 4, 3, almost there. Let me go 1 minute over and end on some more open questions, which I might be almost a little bit philosophical. I've already mentioned the first one. We academic economists, we always like to think about the optimal solution, carefully calibrated policy tools. We also know, of course, calibrated policy tools can be also circumvented more easily. Or rather, do we need crude, broad, binding, implementable measures? The other big question, I think it's an ongoing question, we know that the game between the financial sector and regulators is a bit of like a cat and mouse game. The financial sector is often ahead of the supervisor and tries to come up with new ideas of regulatory arbitrage and risk shifting. How can regulators and supervisors get ahead? And then finally, and I kind of want to come back to this theme as I mentioned earlier, and by the way, I'm not using the word technocrat in a negative way. I see myself as a technocrat. We've kind of come to accept that, for example, monetary policy is being done by independent central banks. Prudential authority should be as far away from politicians as possible. Similarly, macro-pru. We know it doesn't always work, for example, with borrower-based measures. So I remember in Ireland, when during another housing boom just a couple of years ago, the Central Bank of Ireland wanted to tighten borrower-based measures. There was a lot of pressure from the press, but also from the same government. And of course, this raises a broader question is, yes, we have the expertise, we think, we know what to do, but of course we are accountable. We are living in democratic societies, and we cannot just act by ourselves. And the question is it a pure communication issue? Is it an accountability issue? Is it a transparency issue? Which again, we know that transparency can also go too far in regulation. But I think it's an ongoing challenge to say, well, yes, we technocrats know what to do. We technocrats also have the tools, but we are still part of a democratic society, and we are still accountable to elected governments. Thank you very much.
Thank you, Mr. Beck, for your informative speech and the relevant thoughts you have shared with us. Now we will move on to the first panel discussion of the conference. We will hear the thoughts of two panelists on a very highlighted topic in economic policy currently: macroprudential strategies for inflationary episodes and monetary policy normalization. Before the discussion starts, I asked Ms. Anke Weber, advisor and mission chief for Hungary at the International Monetary Fund, to deliver her keynote presentation on this topic, and afterwards to take a seat on the stage. Thank you.
Good morning, and thank you all. It's an honor to join you all today. I'd like to spend my time reflecting a bit on what we have learned about macroprudential policy since the great financial crisis, complementing what we have just heard in the keynote speech, ending with some, by no means exhaustive thoughts on what macroprudential policy should look like at the current juncture. Markus Brunnermeier recently remarked that the role of macroprudential policies is to avoid a financial dominance trap. In other words, macroprudential policies should make sure that the financial sector is sound and solid, so that monetary policymakers or central banks can focus on their objective of price stability. How does macroprudential policy do that? Well, macroprudential policies essentially are based on two broad-based instruments: capital-based and borrower-based. Capital-based instruments have an immediate impact on resilience by increasing buffers, whereas borrower-based measures are meant to restrict credit and price developments, thereby tame the cycle, and over time, gradually also enhance resilience. So unlike microprudential policies, which focus on the soundness of individual institutions, macroprudential policies is concerned with the soundness of the financial sector as a whole. So the macroprudential policy tools have been around for a long time, but the new element of macroprudential policy was really this focus on the overall sector. And why is this so important? Well, you could have a whole bunch of macroprudential policy makers individually doing the right thing, but inadvertently create a perverse outcome at the system level. So in a way, macroprudential policies, it's a little bit like giving walkie-talkies to the microprudential people to make sure that they talk to each other. It's also fair to say that the global financial crisis provided a lot of impetus to formalize prudential policy frameworks. So on the left side chart, you can see that capital and ratios increased a lot. Since 2009, for advanced economies, they almost doubled. For emerging markets, they increased quite significantly. And this, together with rigorous stress tests and enhanced bank governance frameworks, really increased the resilience of the banking sector. On top of that, these measures were underpinned by the deployment of macroprudential tools. On the right side chart, you can see from the IMF's integrated macroprudential policy database a chart which shows the amount of net macroprudential tightening since the GFC. And what we do there is we sum up net macroprudential tightening measures across countries, across 17 instruments, giving a tightening measure a value of +1 and a loosening measure a value of -1. So what you see in the chart is really the net tightening. And that gives us a sense of how tight the stance of macroprudential regulation has been over time. And what you can see in the chart is that macroprudential policies have tightened a lot since the GFC. The post-pandemic global inflation surge provided a very important litmus test of those enhanced prudential frameworks. And if we go back to Brunnermeier's idea that the role of macroprudential policy is to make sure that central banks can focus on price stability, then this boils down in the current juncture to the question of whether central banks were able to raise rates enough to tame inflation. And what we have recently seen is that, indeed, at least so far, this seems to be the case. So on the left side chart, you see nominal policy rates in advanced and emerging countries, and on the right side chart, we are showing core inflation momentum, which, as you can see, has come down a lot and is gradually converging towards inflation objectives over time. And so far, central banks seem to have achieved this, avoiding a financial dominance trap. With the exception of some banking sector turmoil that we saw in US regional banks and a European bank, so far, overall, the financial sector has proven to be relatively resilient. And in fact, if you look at financial conditions, which are shown on the left side chart, they have recently loosened again in the euro area and the United States, based on a market perception that the global economy is in for a soft landing, and also that central banks have the cumulative tightening that they have done is actually enough to bring inflation back to target. And very interestingly, in the current episode, if you look at the right side chart, which shows cumulative bond flows, there haven't been all that much negative spillovers to emerging markets. And that's very different from previous tightening cycles. So the current cycle portfolio outflows, it's the light blue line, and previous major tightening cycles are depicted by the other lines. And you can see that this time around, outflows have been much smaller than before. Now, of course, this is not just due to macroprudential policies. There have been many other important developments. We have seen central bank frameworks strengthen a lot in many countries, and the very aggressive and early response by central banks in emerging markets in terms of tightening their monetary policies also clearly helped. But there seems to be some tentative evidence that macroprudential policies can play an important role in helping central banks achieve their price stability objectives and being shielded from financial dominance. So in this spirit, I'd like to draw on two main questions. The first is a bit more backward-looking, taking a bit more of a scientific approach, looking at IMF work in this area. I'd like to look a bit into what does the empirical evidence actually tell us about the effectiveness of macroprudential policies. And then I'd like to be a bit more forward-looking and take a look at the appropriate macroprudential stance at the current juncture. And as you'll see, that's not an easy question to answer. So let's start with the past evidence. There is evidence that macroprudential policies work. In other words, they are effective in taming the cycle and promoting resilience. On the left side chart, you see the results of a meta-analysis of 60 empirical studies on macroprudential policies. And what this shows is that broad-based tools and liquidity and other tools do actually dampen credit growth. And it also shows that borrower-based tools, which was something that was mentioned earlier in the keynote speech, is actually slightly more effective in terms of dampening credit growth. The chart also shows that studies that are based on microdata instead of macro data generally show larger effects on credit growth, and this is to be expected because there's just more power if we use microdata, and also microdata can overcome some of the endogeneity effects that we get with macrodata because very often macroprudential tools are tightened when credit growth is already high. And when we look at resilience, which is what the right side chart here shows us from another study of colleagues at the IMF that looks at the probability distribution of GDP over time, we see that it's not just the cycle that macroprudential policy influences, but it actually really improves resilience over time. And from the right side chart, we see that the peak effect on resilience of macroprudential policies is actually reached after around 10 quarters. I'd also like to look a little bit into what macroprudential regulation actually does for emerging markets in terms of whether it can shield emerging markets from the global cycle. And here I'm drawing on another study of colleagues at the fund and the BIS. And what they do is they regress GDP growth on the interaction of the strength of macroprudential regulation and also either shocks to global risk aversion or to capital outflows. So the global risk aversion, the VIX shock, 100% increase, you can see on the left side, and the shock to capital outflows is shown on the right side. And what you can see there in terms of the GDP response in emerging markets is that if these countries have low levels of macroprudential regulation, they are affected a lot by global changes in risk aversion and also capital outflows. If they have sufficiently high macroprudential regulation, then there's no longer a significant impact on their GDP from these global developments. The charts also illustrate an important finding of the literature, namely that they are decreasing marginal benefits to tighter macroprudential regulation. So there are initial benefits, but once you tighten macroprudential regulation a lot, the benefits actually decrease. I'd also like to point out that it's not just one individual measure that enhances resilience, but it's really a well-rounded set of macroprudential measures that seems to work best. And this is from the charts here from the same study that I just mentioned, looking at individual macroprudential tools. And the coefficient here, the chart here showing the coefficient on the interaction term. So if the confidence intervals both have the same sign, then it's a significant impact. So you can see that macroprudential policies that focus on credit demand, the FX exposure and liquidity work well in shielding emerging markets from changes in global risk aversion, whereas measures that focus on capital, credit demand, credit supply, and liquidity work very well in shielding EMs from the effect of net capital outflows. Another important question is, well, if a country has very strong macroprudential regulation, does that actually mean that it can pursue a more countercyclical monetary policy response if there are shocks coming from the Fed or the ECB? So again, this is focusing on emerging markets. And what we see on the chart here is that this is indeed the case. So if a country has very low levels of macroprudential regulation, so that would be on the left side of the chart, and there is a tightening shock of the Federal Reserve, then that emerging market actually has to tighten its policy in response to that shock from the Federal Reserve. Once a country has a sufficiently strong level of macroprudential regulation, that effect is actually no longer there. And we could produce a very similar chart looking at global risk aversion shocks. However, if we do the same for capital outflows, we actually do not find that the level of macroprudential regulation shields emerging markets from capital outflow shocks. And this clearly points to the need in emerging market economies to have a broad set of policies to address those shocks, and that directly goes into the integrated policy framework from the IMF. Something that has also been already mentioned is the risk of leakage effects when you deploy macroprudential policies for banks. So there is indeed a risk that people will just shift to the non-banks or foreign borrowing, and this has been well documented in the literature. Here I'm also showing a chart based on the work of mine with Andrew Hodge for the US. We look at the size of the non-bank sector in the US and how it has been evolved, using a new functional approach to actually measure the size of non-bank assets that consolidates across chains of intermediation. And what we see there is that certainly for long-term funding, so for non-banks based on long-term funding, assets have gone up a lot, including during the pandemic, and have continued doing so. So what this means is it really points to an importance of expanding the perimeter of macroprudential policy action to the non-banks. And there are several work streams already underway in terms of closing data gaps and enhancing regulation and supervision. One thing this conference is also about identifying new areas for research. In my view, an area for more research is clearly which macroprudential policies work for non-banks and how should they be calibrated. So with those lessons from the past, I'd like to turn to today. What should policymakers do at the current juncture? And I'll argue that this is still a time to focus on building up resilience of the financial sector. Let me look first at where we are in the various cycles. So in principle, when you think about macroprudential policy, policymakers should tighten policies when times are good and loosen when times are bad. Now, this sounds really easy in theory, but it's actually pretty tough in practice. And one question is really, well, which cycle should we look at? Let's look at monetary policy first on the left side chart. So here I'm showing the US Fed, the federal funds rate, and the Federal Reserve balance sheet, both historical as well as expectations, market expectations in case of the federal funds rate. What we can see in terms of the federal funds rate is that markets now expect the Fed to start cutting rates in Q2 this year. And there's also still an expectation that quantitative tightening, so reduction of the Federal Reserve's balance sheets, will continue at least for some time. So already there are two developments going in potentially different directions. On the middle chart, I'm showing the global credit cycle based on Standard & Poor's measure. And this is an indicator that takes into account household debt, corporate debt, housing prices, and equity prices. And it tends to lead recessions and upturns by about 1.5 years. Now, if we look at this indicator, the question arises, is it just about to turn around? Which would mean that we could see an upturn in credit developments sometime in 2025? Or is there more stress to come? Has this indicator, in fact, not bottomed out, and is it going to decline further? And if we look at just one sub-indicator, housing, we have seen that the housing cycle has turned around in quite a few countries, but in others, that hasn't been the case. So again, that's a bit of a mixed picture. And if we look at the very immediate future, so 2024, there is a chance, and this has also already been mentioned, that 2024 you could see some risks emerge on the horizon. And this is not least because banks are facing several headwinds. Bank profitability, which has gone up a lot, will likely decline. I mean, we have seen a lot of this profitability stemming from very low deposit betas, which could eventually pick up. We might see policy rates in the large advanced economies come down. And on top of that, there are still the lagged effects of the tightening, of the monetary policy tightening that we have seen in the system. And these already have led to some deterioration in asset quality and could lead to more pronounced deterioration. A case in point is the commercial real estate. So I'm showing a chart here from the US where we have both seen CMBS and REITs tick up in the recent period. And we have also seen some related stresses in European countries. So at the current conjuncture, some policymakers might just say, well, things are really uncertain, so maybe I'll just wait and keep my policies as they are at the moment. What I'd like to do is just go back once more to the COVID pandemic and the past and what we have learned, and maybe see if that can inform policies going forward. And there have been 3 lessons, I think, that can be learned from the COVID pandemic. The first one is that a positive neutral countercyclical capital buffer can provide additional headroom in periods of stress. And we have seen recent evidence that this has actually worked in practice, namely during COVID. So there's a paper by Bergand and Forbes that actually shows that countries that were able to release buffers during COVID experienced less economic and financial stress. And what you can see on the chart here, which is just putting a picture again on what was already mentioned in the keynote speech, is that some countries did actually release those buffers during COVID, and this was especially the case in AEs, which just tended to have higher capital buffers. But what we can also see, what we also know, and we can't see it from this chart actually, but we know it, so there are 85 countries that actually have a CCYB framework in place. But out of those 85, 66 during the COVID pandemic did not have any releasable buffers. So that's a bit of a problem, given that we have shown the effectiveness of such buffers in practice. And the other lesson to be learned is that countries did not use usable capital buffers during the COVID crisis. Why? Again, already touched on in the keynote speech. It may be stigma. It may be that there is an asymmetry in markets' perceptions. Markets really care a lot about capital when times are bad, not so much when times are good. So banks really try to defend their headroom over usable buffers during the crisis by essentially doing a pro-cyclical credit reduction. And so a lesson there is that releasable buffers can really be very helpful in periods of stress, and they can also help overcoming that stigma, because the call to actually release the CCYB would be coming from the macroprudential supervisors. So I'd argue that it's still the right time to build up releasable buffers, at least in some countries. And these buffers can actually be built up irrespective of the credit cycle. I mean, one problem with some indicators that supervisors and central banks tend to use, the credit gap to GDP, is that it can stay negative for a very long period of time when stresses are already building up. So a nice thing about the CCYB, the positive neutral CCYB, is that it can actually be built up irrespective of where we are in the credit cycle. Importantly, the build-up should not be done at a time when the supply of credit is constrained by capital requirements. So you want to be in a period where banks still have voluntary buffers in place they could use, and also plenty of capital, so to avoid any procyclical tightening in credit. And so after the normal risk phase, where you start building up the CCYB, one would then go into a phase where the supervisor or macroprudential authority sees risks building up, and one could use some early warning indicators to actually get a sense of whether we are in this phase. And then once financial stress actually hits, you release the positive neutral CCYB. And it's also shown in this chart, which arguably is a very simplistic depiction of reality, that with a positive neutral CCYB, one is always above a CCYB, which would add 0. So the capital releasable buffers are always higher in all stages of the cycle. Now, of course, this has to be country-specific, so it needs to reflect benefits and adjustment costs. So policymakers should look at existing vulnerabilities. The chart here shows Europe. It shows just 2 vulnerability, household leverage, and the share of variable rate mortgages. And there already you can see how heterogeneous countries are in terms of those vulnerabilities. And the chart doesn't even show some of the mitigating measures in place, such as borrower-based measures. Policymakers should also assess, is this a time where banks are actually constrained by capital? So one could look at bank profitability, the level of voluntary buffers, and lending surveys can also give a sense of whether credit provision is constrained. One could also, in some countries, consider a more targeted buffer, so systemic risk buffer, say for commercial real estate or residential real estate, also something that we have seen in some countries. So I'd say, as I already mentioned, that this is still a time to think about building up these releasable capital buffers. Based on our research at the fund, we have also seen that there may be an argument to actually have a higher positive neutral CCYB in emerging economies than advanced economies, because we've just seen that in crisis cases, we've just seen a bigger impact on those countries than advanced economies. So let me conclude. I have argued that macroprudential policies work. They have some effectiveness in avoiding a financial dominance trap. I've also argued that at the current juncture, macroprudential policy should focus on their resilience-building aspects, less on the cyclical aspects. And I've also made a case for a positive neutral CCYB to be considered as an important tool, of course, considering country specifics. It's also obvious that limiting financial stability risks cannot and should not rest entirely on the macroprudential leg. So it needs to be clearly coordinated with other policies, macroprudential resolution. We'll hear more about that during this very interesting conference. And finally, also just a plea for some countries to rebuild fiscal space, which has been depleted, because like financial dominance, you don't want fiscal dominance overshadow central banks' price stability objectives. Thank you very much.
Thank you, Ms. Weber, for your presentation. Now it is my pleasure to ask Mr. Barnabás Virág, Deputy Governor of the Magyar Nemzeti Bank, responsible for monetary policy and financial stability, to moderate this panel. The members of the panel are Ms. Anke Weber, Advisor and Mission Chief for Hungary at the IMF, and Mr. Jan Freit, Deputy Governor at the Czech National Bank. Please join us on stage.
I hope my microphone is working, so good morning to everyone again. It's a pleasure to be here, and thank you very much for our panelists accepting our invitation to this panel. Originally, I planned to show some charts as an introductory thought, but now I would like to skip that. We are a little bit behind of our times, so let me say some words only as an introductory remarks after the very interesting speeches we heard today morning. I have to say that I started my career in the central bank in 2003, 20 years ago, and I think my career is a pretty good example how the central bankers' relations to the financial stability changed. So I remember in 2003, we lived in an area where we introduced the inflation targeting regime here in Hungary in 2001. We joined to the European Union in 2004. So we strongly believe in the central bank that we have one tool and one target. The primary target is the price stability. So the best thing the central bankers can do is to provide the price stability to our economy, and through that we can provide the stability generally. So in line with that, we made a lot of efforts to read well, to understand the cyclical movement of the economy, and we build huge macroeconometric models with standard Taylor rules and so on and so on. And we also strongly believe that the money is neutral in mid-term. So that was the case before the great financial crisis in Hungary. After that, the great financial crisis occurred, and we learned very, very deep lessons, I think generally as a central bankers, and especially here in Hungary. So I think it was clear after the great financial crisis it's not enough to provide price stability in our economies. We have to deal with the financial cycles. So we have to make extra efforts to stabilize the financial sector on the one hand, and of course in our case we learned the very painful lesson of the risk from lending in foreign currencies. So after the great financial crisis, the central bankers turned to the era of prudential policies, as we heard from Anke. Also here in the region, so we got very strong measures, very strong tools in our toolkits on the macroprudential and on the microprudential fields. We use that in a very active way. I strongly believe that nowadays we are benefiting from those steps we made in the last decade. But on the other hand, we are facing again with a high inflation environment. So I remember before the COVID-19 crisis and the end of last decade, we had conferences about the lower for longer topic, about the disappearing inflation issues. So that was the key question before the COVID-19 crisis. But now we know, well, we are living in an absolutely new decade, in the decade of volatility, in the decade of great transitions, where the supply side shocks are we can say, a usual phenomenon nowadays. So that's the life again, where it's not enough to know more about the demand side, the cyclical movements of the economy. We have to deal with huge supply side shocks, which can occur in every year. And I think I think the challenge from this decade is much larger than it was in the last 2 decades. So that's why I absolutely agree with those results I heard from Anke. We have to deal with the macroprudential issues. We have to find the proper interaction between the standard fiscal monetary policy measures and the prudential tools, because the challenges are pretty big. So that's my introductory talks to the panel, and now I would like to give the floor to Jan. I mentioned that I started my career in the central bank in 2003. If I'm right, Jan started a little bit earlier in the Czech National Bank. During his whole career, Jan was responsible for financial stability, if I'm right, and he was appointed as a deputy governor in 2022. And now Jan will give some further introductory remarks to the panel. So, Jan, the floor is yours.
Thank you. Dear Barnabas, dear colleagues, thanks a lot for giving me an opportunity to be back here right after 2 years. The 2 years that were very interesting from the point of view of the policymaker. Nevertheless, it is 2024. Magyar Nemzeti Bank is celebrating 100th anniversary. Congratulations. It is well known. There is a completely unknown anniversary. It is symbolic for me. It is right 20 years. The Czech National Bank, the board, under my advice as a head of projection team, established a financial policy, financial stability objective, and created a macroprudential policy team. And the credit goes to 2 guys from small open economies, Bill White and Claudio Borio, who were, as chief economists of the BIS, very persuasive in telling us what to do. Well, we are approaching the end of the first quarter of the 21st century. I started in the Czech National Bank in 2020. I moved directly from academia. I was a professor of international money, and I moved right to the board. And at the beginning of the century, we expected continuation of great moderation that we saw in fancy American textbooks. And at the same time, we believed in the principle of policy separation. I use here a very strong slogan from Ben Bernanke, use the right tool for the job, which means that you should use monetary policy for your macro objectives and supervisory roles for financial stability. Well, we are now nearly 25 years older, and we have not seen a great moderation. What we saw was more great macro financial volatility, and we saw a lot of swings in macro and asset markets. So the world is somehow uprooted, and my question, what is to blame? Actually, it is not that much financial policy these days. We also have something like a 15-year anniversary of the start of the Basel reform. So roughly in 2009, we started discussing what to do in financial regulation to avoid global financial crisis. I was actually in the middle of these discussions, and initially we had a lot of expectations. You can see the list, I will not read it. And not everything was done right, actually. We don't have something we had believed that we would have it. Nevertheless, we achieved quite a lot. The community achieved quite a lot, so we have a lot of tools and powers that we badly need, and we use them. Maybe the powers are not strong in fighting with the cycle, with the financial credit cycle. What we have counter-cyclical capital buffer, and in Europe we use it. A lot of European countries do have positive CCYB rate, and the countries apply it in a counter-cyclical manner, which is fine. A typical example is the Czech National Bank. We have pretty nice cycles, so we go up and down and up and down. We can maybe discuss later on in the discussion why we do so. We apply formally what we call standard, or it is sometimes called now fashionably neutral rate. We have it formally at 1%, but discussing whether 1 is enough. We also used border-based measures in a counter-cyclical way. It is very controversial. In the bank, inside the Czech National Bank, we don't have a consensus on this, and we argue quite a lot. But we do apply it as a counter-cyclical tool. So if you study the developments in LTV, DTI, and DSTI limits, we go up and down sometimes. And as to the DTI and DSTI limit, we sometimes have it. And for example, these days we don't have it. We switch it off because we face very low demand for mortgage credit. If there is one disappointment for us that we're discussing the reforms right after the global financial crisis, these are swings in asset markets, in particular property market. We saw pretty wild development, for example, in the nominal commercial real estate prices you can see here around the global financial crisis. And the objective was supposed to be not to allow it in the future. The same happened in recent years. What is really humiliating is also the development in residential real estate market. What you see here, these are real, that is after inflation, cumulative changes of residential property prices in advanced, mainly inflation targeting countries. We saw significant increase before the global financial crisis. And we have seen the same recently. Of course, there could be some structural demographic factors behind it, but there must be definitely monetary policy behind it. So if you ask me what to do better in the future, my response is, first, we have to coordinate monetary and financial policies more closely, forget about policy separation. Second, we have to factor our experience from great macro financial volatility in our inflation targeting framework. I'm a little bit provocative, but I think we need something like Basel III for monetary policy in advanced economies. I agree with a lot of colleagues saying that we need to extend a macroprudential approach beyond the banking sector. And on top of it, what we need most badly, it's luck. Luck is the essential tool of a policymaker, and without luck you can hardly succeed, and I wish you a lot of luck in the next year in your policies. Thank you.
Okay, Jan, thank you very much for your introductory talks, and let's start the panel discussion. I would like to start with a macro question linked to the disinflation and to the likelihood of soft landing. We heard a lot this word, soft landing, but I think looking at the data, the soft landing doesn't mean the same in the US and in our region, in Central Eastern Europe. So if I look at the numbers in the region, in the last year we saw recession in the Baltic countries, in Hungary. The Czech GDP level is near to that level the numbers were before the COVID-19 crisis. So it seems to me that the soft landing scenario is not the same in everywhere in the world. So my first question to you, to Anke, so what are the key indicators that suggest a shift towards a soft or hard landing environment, and what are the most uncertain factors in that story?
Is this...
Let's start to speak.
Okay, we'll pick up? Yeah. Ah, great. So thanks for the question. So I think I'd start with a little bit of how I see or what I would define as a soft landing, because we see the word quite a lot in the newspapers, and it's not always clear what we mean by it. So the way I would define it is a gradual convergence of inflation back to target without a too deep recession while labor markets stay resilient. So under this definition, so far what we're seeing in the US and some advanced countries, overall the euro area, I mean there are some that are not doing as strongly, I think it will still qualify. Even Hungary, I think if we look at the current disinflation period, it looks like a successful one in terms of inflation coming down.
We hope that we try to deliver our best.
So what indicators would I look at given that definition? Well, obviously inflation. We have seen a lot of goods disinflation. So to us, everywhere, the question is a bit what's going to happen to services inflation? Is that going to be a bit more persistent and sticky? Certainly something we look at very closely in our Hungary surveillance, also given still very strong wage growth in Hungary and also other Central and Eastern European countries. If we look at the global projection from the fund, if we look at the January WEO, we do see disinflation continuing towards target this year. So our baseline would be consistent with a soft landing there. I'd also look at output, GDP. So there, for Hungary, we expect a recovery this year. Globally speaking, our January WEO was at around 3% global GDP growth in 2024 and 2025. So again, a baseline consistent with a soft landing. I'd look at labor markets as an indicator. Labor markets to me is a bit of a very interesting story because I still remember when Christopher Waller came out with his paper. I was on the US team at that time. And he argued, yes, it's possible. You can see a decrease in vacancies without unemployment going up. I mean, that was a very controversial statement. Many people believe that wasn't possible, but that's a lot of what we have seen so far. We have seen vacancies come down and unemployment stay relatively low. And then in the spirit of this conference, I'd look at financial stability, of course, financial stability, soundness indicators. Again, there so far it doesn't look so bad. I mean, bank profitability is up. Yes, asset quality has deteriorated a little bit, but not so much. So we have a baseline of a soft landing. You asked about what are the risks around this? What are the uncertain factors? It's a couple of things. It's, first of all, the asset quality question. Have we just not seen the impact of the monetary tightening because more countries have more fixed rate mortgages? Is it just going to take time? Is it going to feed through the system? Or are we out of the woods? Because again, the more forward-looking nature of the financial markets, since they expect interest rate cuts in major AEs, financial conditions are actually pretty loose. So for financial stability, which one of those two is going to dominate is going to depend on the pace of disinflation. So any inflation surprises where inflation is higher than what markets expected, you see a lot of volatility and movement. So that's going to be what I would watch. And of course, just given the medium-term vulnerabilities of high public and private sector debt, any shocks to disinflation, any outcome where central banks stay tighter for longer could lead to some hiccups there on the financial markets.
Okay, thank you very much, Anke. The same question to you, Jan. So I have to say that I'm pretty interested in the Czech case and in the Czech story, because looking at the macro outcome, you were pretty successful in reaching your inflation target against, or the latest data was 2%. In the Czech Republic, while on the other hand, there are some lag in the real economic output. So what's your reading of the data?
Well, I will start generally. If we go back to the end of COVID period, the world looked like a tower of private and public debt. So the level of indebtedness was enormous. And now we are at the end of unexpected inflationary wave, which was a very positive shock for debtors. So there's no wonder that there is no hard landing. The debtors were being helped quite a lot. But it is for sure that a lot of private projects from the past were or made sense only in a very low interest rate environment and may have no sense anymore. And it is for sure that the private debtors will press on central banks to go down with rates quite a bit. And at the same time, private markets will press on the governments to help the economy, help the private economy under various slogans. That is what we see actually. And as to the Czech economy, the economy is really weak. It is no surprise, first, because we have kept relatively tight monetary policy for some time. And second, the typical behavior of the Czech consumer is that if there is a series of bad news, the consumer is not smoothing out consumption over time. We are like Germans, so we step on a brake and stop spending. And it takes some time of more positive or less negative news to adjust behavior and start spending. I think it is very slowly happening now. So people are being less negative or a little bit more confident about the future development of real incomes. And it seems that this year real incomes of households will start growing positively, and with some delay it will somehow help consumption. At the same time, our government is not running deficits that are so as high as in some other advanced economies or neighbor countries. Foreign financial analysts view this as a negative thing because it depresses GDP. I just hope that after some time it will also help somehow the economy becoming more confident, I would say robust in the eyes of investors, and temporarily it creates a slow GDP growth, but in the long run it can help. At least we have the experience from the past this way. What I fear actually is that the investors can again start underestimating risks, and not only financial risks, because there was no recession, there was no hard landing, and they may start thinking that we are back again where we were a couple of years ago, and once we forget about the risks, this is exactly the time where the macro risk can get out of control. So that's my concern, not the current time, but maybe some times in a relatively not so much distant future.
Okay, thank you very much, Jan. So let's move to from the macro issues to the issues related to the financial sector and to the credit development. So if I look at the main drivers behind the credit market, I would like to mention two key areas. So the first one is the labor market, as you mentioned, Danke. So nowadays we have a pretty strong labor markets in the region, in Europe, also in the US, and in everywhere. The increase in real wages started at the end of last year, in line with the lower inflation environment. While on the other hand, if I look at the level of real interest rates, it's also clear that the financial conditions nowadays tighter than it was in the last decade, and I strongly believe we stepped into the era of positive real interest rate environment again, and not only for 1 or 2 years, but I think that will be the new character element of the decade. So that's the situation nowadays. We have one supportive element, which is coming from the labor market. We have one restrictive element, which is coming from the structural changes in the field of financial conditions, in the field of monetary policy. So my question is, how persistent would be the decline in the credit market in lending we can see nowadays, or the turnaround is pretty close to us?
It's the $1 million question. I mean, So what I would say is, and I touched on this already in my presentation, is that there are a lot of forces going into different directions right now. So as you noted, we have resilient labor markets. We are going to see a recovery in some countries, whereas in others, growth is actually slowing down this year. When we look at lending surveys, so for instance, when we look at the ECB's last lending survey in late 2023, that was still pointing to a contraction of bank credit. And when we look at global financial conditions, they are actually losers. So if you're a firm financing yourself, not with a traditional bank base, but you're corporate, in terms of corporate bonds, spreads have actually come down recently. So I think there are lots of things going in different direction. In a traditional bank-based system, I think that in the immediate term, credit is still going to be quite weak. Also consistent, again, with the latest bank lending survey in the euro area that was showing a continued moderate contraction. On the other hand, it was pointing to some nascent signs that things might turn around. So perhaps in 2025, we might see credit and therefore also in investment restarting a bit. And you mentioned the higher real interest rates right now. So one risk, of course, in this is firms or households that need to refinance themselves. So we have seen a lot of them refinance during the pandemic when rates were very low, but certainly for the corporates there are some loans coming up, and that could be a risk going forward.
Okay. So let me raise a country-specific question to you, Jan. So you, when I'm looking at the communication of the Czech National Bank on the field of monetary policy, sometimes you touch the issue of the need of positive neutral real rates on one hand, and on the other hand, looking at your chart in your presentation, you mentioned that you actively use the macroprudential tools like the CCYB. So my question, what is the Czech experience regarding the more active use of the CCYB and the positive neutral rate together?
Okay, it is a relatively long history, but when the debate about the CCYB started years ago, we created a methodology and a kind of strategy. And we were one of the first macroprudential supervisors that started to use it as a positive CCYB. And our experience is that it is good not to be extremely opportunistic, and that it is good to stick to the strategy you establish and that it works. And the strategy was, let us decide on the CCYB according to the cyclical indicators. And this is, we have something like an indicator of financial cycle. Then we look at the cyclical developments in risk weights, and we apply also some cyclical measures from the stress testing exercises. And we put it somehow together, and the CCYB reflects these three cyclical gauges, roughly. And then we made a mistake. We made a mistake in COVID, because we were under stress, under general panic, and we decided to cut CCYB despite the methodology that was saying, don't cut it unless there are true losses in the banking sector. That was not, actually the outcome was not bad, because at the same time there was a ban on dividend restriction, and after COVID was over, so we started to accumulate CCYB again. But the decision is now, we will not cut CCYB just under panic, under some abstract stress. We are going to wait for true losses. But then we have a different situation now that started last year, because our standards, our methodology is saying, cut CCYB if cyclical risks go down. And if we look at our indicators and the measures of cyclical risks, no matter what we do, how deep we dig in the dirt, we cannot find these cyclical risks. So it is controversial, but we decided to do so. We cut to 1.75 now. We are discussing that we will probably not go to 1%, which is a neutral rate. We will maybe stay somewhere higher. But still, we view, and for us it is a signaling policy, signaling tool actually, because all the time the banks keep relatively sizable management buffers, and our decision on CCYB is just shifting part of the capital from voluntarily held to CCYB held. So it is just a signaling tool saying to the banks, okay, be cautious or be less cautious or something like this. Otherwise, the material meaning of the CCYB up to date has been quite limited. Maybe the last point, actually, we would like to, my personal view is that the 2.5% limit of CCYB is too low. We should likely agree internationally, which is difficult, but we should to agree on a higher limit, and we should be more active, more really cyclical in using this buffer as a truly counter-cyclical buffer, because the evidence is that it is not that easy to use it, and it is not that easy to cut it if needed. So I would suggest, I would support some rethink of this tool, but otherwise we are quite happy with it.
Thank you very much. I have to say that we closely monitor and look at your experiences. So let me move to, how to say, a little bit sensitive question, which is the record high profits in the banking sector on the one hand, and on the other hand, the taxation of these profits. I have to say that I'm in a very special position in the central bank, because I'm the deputy governor who is responsible for monetary policy on one hand and for the financial stability on the other hand. So that's why when I'm looking at the pretty high profit numbers in case of the Hungarian commercial banks, I'm happy on one hand, but I'm also sad on the other hand. So of course I'm happy because the higher profit numbers can support our commercial banks for a healthy operation in the future. But on the other hand, it's clear the very high profitability of the sector, especially coming from a weak monetary transmission, which would be a key element of our operation in a high inflation environment. And it's also clear that that in the last couple of years, also the governments realized this very high profitability in the banking industry. So in line with that, they introduced measures in many countries to as a taxation in the system. So my question to our panelists is that should the high profits be taxed higher and redistributed to ease the fiscal pressure stemming from the high inflationary and interest rate environment? Or what can be the optimum mix between helping households and firms in need and maintaining banks' lending capacities? So that's the provocative question to both panelists. Anke, please.
It's not so provocative, since we have a very clear line on this in the European Department. So we would argue that this is still a time for a prudent distribution of bank dividends to preserve adequate capital buffers. And we have also mentioned, including in our regional economic outlook for Europe, that we don't support the imposition of discretionary and ad hoc taxes on bank profits. I would also observe that, number one, and this is something I mentioned in my presentation, probably this very high profitability is temporary to some extent. I mean, we don't have a crystal ball and there are different things going on, but still, if asset quality continues to deteriorate, that's going to eat into provision. If central bank rates are coming down, and eventually I think these deposit betas, which as you noted were just really low in this tightening cycle, eventually they might catch up. So all of this, together with low credit demand, points to bank profitability being temporary. So we would not support these taxes. Instead, I would mention that those countries, so these bank taxes are actually a very European phenomenon. So since 2023, we have seen that new taxes imposed in 12 out of 27 EU countries. And we would also note that in those 12 countries, those are actually the countries where there is actually quite a bit of room to increase the CCYB, in our view. So we'd rather see that. You also had a question how to help household and firms. And I would argue that to help household and firms, you want to make sure that if there are crisis or stress times ahead, that banks don't cut lending and credit. And the CCYB, I think, based on the research, can be an important tool there. So our recommendation would be no to these discretionary ad hoc bank profits, and yes to really rethinking some of these releasable buffers in the system and using some of that profitability for that.
Okay, that's clear. Jan?
I'm currently in charge of microprudential supervision, and this is the question I face quite often also from politicians. I use one trick. I say at the beginning, okay, people tend to idealize alternatives. So if you go back in time until 2001, the banks were in domestic hands, and they were not profitable. They were losing a lot of money, paying no income taxes, and the government was sending a huge amount of finance to bail it out, actually. So, and I also usually ask, do you want it back? And they say, no. We just see that they have a lot of profits over years, and these profits are sent abroad because most banks are falling out. But I say, okay, but it is not that easy to move. Ideally, it would be perfect to have domestic banks only and being pretty reasonably profitable. But you cannot achieve that. It's not that easy. You cannot administrate it. So, my preference and the Czech national preference is, okay, let us keep current state, which means that the banks have a lot of managerial buffers. They are able to support the economy. They are able to support projects if there are some. The problem is there is a limited number of projects. The government is not efficient. Municipalities have 25 billion euros on their accounts, and they are not able to spend it actually on projects because everything takes time. So we say to the politicians, do not try to tax it extra because it is going to change behavior completely. And you know, and the outcome could be something pretty unexpected. Whether we are successful in the future with this strategy, I'm not sure, but at least what we try to achieve.
Thank you very much. So let me move to the last question in our panel. So that's the topic of climate change and the climate change related to risk and macroprudential policy. So now first I would like to turn to you, Jan, because in the last couple of years I had many conversations with Czech central bankers, and one of my feelings was that your central bank remained on the on the conservative approach regarding the climate issue and climate-related risk. So what can you say to us now? Should and how can climate risk be incorporated into the existing prudential frameworks into our daily life in the central banks?
Well, the countries and the firms, institutions tend to specialize on something they do over some long time. So in Czech Republic, we know how to produce current cars, for example. In the Czech National Bank, we know how to conduct counter-cyclical policies. We have a lot of duties and responsibilities, and at the same time, the DNA of the Czech National Bank is that we are a very non-political institution. And our understanding is that a lot of things in greening policies or environmental policies, they're pretty closely touch politics. So a lot of things are of a political nature. So we prefer ask guys from Netherlands or from UK or countries that really do study these things in detail, and maybe we will advise them on these counter-cyclical things. So that's why we are pretty conservative. And if we are asked about some component of macroprudential policy that is associated, we say, okay, maybe we can include these financial risk associated with global climate change into something like systemic risk buffer, but we should be very cautious in linking that to particular exposures or institutions as I say, it could be pretty difficult and pretty political. So we are looking at what the others in EU and in the world do, and we will maybe learn something, but we don't think that we need to be somewhere in front in all these areas.
Thank you very much, Jan. And my last question is going to Anke. So what are the potential trade-offs and challenges when deploying standard macroprudential instruments to address climate-related financial risk?
I mean, it's a tough question, because I think this whole agenda is still a bit of work in progress. So what is fair to say is that if we look at what we do in standard stress testing for banks, then when we do a standard bank stress test, we know quite a bit about how macro-financial risks are linked to bank capital. So in our kind of standard non-climate change world, I think we have quite a bit of knowledge there. What is tricky about climate is that a climate stress test is subject to lots of uncertainties. I mean, there's uncertainty about which model to use to capture climate change. There is uncertainty about data. I mean, there's also data availability issues in terms of data on transition risks. So when we do our financial stability assessments, we see in a lot of jurisdictions that there's not a lot of data that can be used to actually incorporate in those stress tests. With our standard bank stress tests, very often we assume it's a static balance sheet for the bank as a simplifying assumption. Very hard to make that argument with climate change, because it's structural, it's going to move over time. And then there's a lot of uncertainty about what will happen in terms of climate change policies, and that would affect these stress tests. So I think stress testing is very hard, and also just what are the links then of these stress tests to bank capital, which goes into how do we treat it in terms of a prudential question. What I can say is that there is consensus, I think, that for individual bank supervisors, they should definitely go to the banks, follow up what they are doing in terms of their risk exposures, how they are looking at their portfolios in terms of those risks, and follow up as needed. In terms of the macroprudential policy side, I think there is maybe not a need for new policies or new tools, but maybe adapting existing one, but that's very much work in progress. Some qualitative work has been done. So for instance, we did a financial stability assessment for the Bahamas in 2018, and that's a small island economy, very much subject to hurricanes. And there, in that FSAP, we actually recommended for capital buffers to be higher for banks in the Bahamas because of that hurricane risk, and given the impact that it has on the collateral, because many houses are actually not insured in the Bahamas. If you don't have a mortgage, people then don't tend to be. And they also changed that requirement for insurance if you have a mortgage. You could also think about a country that's subject to flooding. And so thinking about borrower-based tools, loan-to-value ratios that maybe take into account flooding risks and the impact that has on collateral. But all of this, I'd say, is still very qualitative. And the question of how to quantify that and formalize it in the context of macroprudential frameworks, that's still very much work in progress. We as the fund, we are part of a lot of these initiatives, the NFGS, and this is a question that is being looked at very carefully.
Okay, thank you very much. So now we are getting the end of our time. So let me sum up briefly the first panel we had here. So yeah, looking at the key macro variables, we can say we are getting probably out of the wood nowadays, but we have to be very cautious because the situation can change one day to the other. So we cannot sit back. It's clear. And we have to continue the very disciplined monetary policy and prudential policy actions we did in the last years and in the last and we built up in the last decade. So I think that's the proper approach nowadays we can deliver. So I would like to thank to our panelists, to Anke, to Jan, your very interesting and useful talked to this topic, and of course I would like to thank the attention to our audience. Thank you very much.
Thank you, Deputy Governor, for guiding us through the first panel, and I also thank the participants for this valuable discussion. Now we would like to open the floor for questions from the audience, if there are any.
So there is one question here.
Hello, Steffen Meuse from German BaFin. What do you consider the bigger climate risk? Is it uninsured assets in the bank balances, or is it op risk from decisions of the governments?
Definitely the decisions by the government. I think we made the financial system, in particular banking system, pretty robust. And maybe we are in micro supervision a bit tougher than needed. So maybe we should allow the banking sector to be going slightly more into the risks, and at the same time maybe having a little bit more capital. But the system is pretty robust. So I think it's these uninsured risks, I think this is something the banks account for, actually. So I think that if there is a major risk, it is policies that are difficult to adjust, or the bad policies of any kind that make economy weak and somehow not vulnerable and not robust enough. So that's I would definitely bet for the second choice.
There are questions here.
Thank you. I was a bit surprised, Jan, when you called it a mistake to lower the counter-cyclical capital buffer in spring 2020. Does it refer specifically to the Czech situation? Does it refer specifically to this one tool? Because there were also other, like the conservation buffer, which was reduced. Conservation, sorry. Or is it because it was together with the other support measures that were put in place? I mean, because again, seemed almost like a consensus back then to lower all of these capital buffers. So I was a bit surprised to hear that you now, looking backwards, call it a mistake.
It's my long-term topic. It's a herding behavior in central banking and supervisory community. So what we do is very often is what the others do, not what is the optimal policy. But I say it is a mistake on an ex-post basis. So, of course, on an ex-ante basis, it was a undiscussed policy, actually. So, because we were, the private sector was saying, please do anything that somehow increases faith in the economy. So we did so. But on an ex-post view, I think it was against our, let's say, standards and policy announcements, and in the long term, it can weaken your credibility in a way. So that's, I said, we won't do it the second time. We have to definitely keep tough nerves. And so the private sector learned a lot in the COVID crisis to whimper, to complain, to press on the government to help. So we have to be quite resistant, because it is a new philosophy, and this is not the philosophy that is producing huge economic benefits.
Thank you. So the last question in the second row, please.
Yeah, thank you. I just want to do a small clarification regarding climate change risk. Although I acknowledge that in the Bahamas and countries similar to them, this risk of extreme events is quite important. But for the rest of the world, there is another risk that is not normally accounted for, which is the chronic part of climate change. And that's even more important. In the work that we do at the Central Bank of Mexico, we have learned that it's about 90% of the economic impact of climate change. So that's a lot. That's most of the effect. So I think that hurricanes and floods, that's all very important. But there is this chronic part which will stick to the economies that is very, very important to take into account. That is the first thing. And then when I was listening to Professor Thorsten Beck on the needs for macroprudential policies, I think climate change is sticking in all of these characteristics. So my question would be, what is your perception regarding, for example, these very recent events in Europe of the transition, that sort of very urgent need to revise all the risk coming from this sudden transition to more carbon-free or not dependence on gas and oil? All this, it's very important. And we saw that in a very recent period. And this, once the effects of the early impacts of climate change are starting to manifestate in the coming years, this could also develop very fast. So I would like to know your view from the IMF. That I know that you have been doing wonderful work. In the last FSAP in Mexico, we had one important part of the FSAP dedicated to climate change.
Anke?
Sure, happy to answer that. So indeed, I mean, I gave the Bahamas example because it was a country that I used to be the mission chief for some years ago. That doesn't mean that this is the main risk we are concerned about. Indeed, this whole area of transition risks, stranded assets on bank balance sheets is actually one that we are looking at very closely. And that's actually the one, perhaps not in the case of Mexico, but in many other countries, where there are important data gaps that we think need to be filled for stress tests to actually then incorporate those risks. But I agree with you that is, in a way, for the banks, a much more important risk than the natural disasters themselves. So hopefully my answer wasn't too misleading in that aspect, but I just gave one of the recent examples I was quite familiar with. Thank you.
Okay, thank you very much for the questions and for the great interest we got. Now, if I'm right, we are going to the...
We will have a 15-minute break.
Yeah, so we have...
Yes.
The liquidity is very important, not only for the banks.
So now 15-minute break is coming up, and afterwards we come back with our next panel discussion on geopolitics and financial fragmentation. For those following online, as we end here the live streaming of the conference, thank you for joining us today. The full recording of the conference will be available after on the official MNB YouTube channel in due course. Thank you. Thank you.